Gold, gold, gold. Welcome to another episode of Mere Finance. Today we're going to talk about Bitcoin and gold, especially gold, how this asset class is moving, and why we consider its price movement as the mere repudiation of the dollar above anything else. So don't forget to subscribe. Let's start. So this is Charlie Bilello. He's with Creative Planning, and he's showing the total asset class return since 2011 as of Friday. You can see how gold has done really well this year at 24%. It's the second one after Bitcoin. Both of them completely decentralized, both of them without any default risk, without any cash flow, completely decentralized assets. And you can see how at 24% and 43%, they are going up because of the dollar weakening, because of inflation, and because of deficits across multiple nations, just showing that it won't recede, that the fiat currency is getting weaker and weaker, and that BTC and gold not only provide better returns, but also better store of value. Now, store of value is something that doesn't have tail risk. We think gold and BTC has tail risk, but in store of value within the asset class. Why do we say that? Because even people said that in 2022, when everything was red, you can see here in the column 2022, everything was red, gold wasn't up, but gold was only down 80 bips, while the S&P 500 was down 20 bips, and where even the total bond market was down 13%. So gold, in an annualized basis, has defeated emerging market bonds and stocks, high yield investment grade bonds, and the total bond market, and convertible bonds, long duration, cash, commodities. Basically, the alternative to stocks should be gold in just pure terms of return. So what is this telling us? That in quarter two, the total gold demand reaches highs on record, around, you see, 1.4 tons. And this comes in ETF, in physical gold, in jewelry. But this comes across multiple players within the economy and technology. And what is it telling? Well, gold is the thermometer, or the repudiation thermometer to globalism and government policies. And why do we say that? Because throughout history, through wars, through multiple economic theory and policies and systems, gold always remains as the credit note. Everything else is just worthless. So gold is completely centralized. You cannot be sanctioned with your gold. You cannot be tracked with gold. You can move it. You can completely have control of that instead of a fiat currency that depends on government policy. So the increase of gold demand is because of the increased expectations of central bank easing, so equals a new all-time high in US dollars. We're going to show how as the US dollar goes down, the gold goes up. The correlation is there. There's also, as I was saying, safe haven flows. Middle East tension support, or also in the Ukraine and Russia war. You cannot sanction countries without expecting them not to go into alternative system, which is gold. And also through war, everything gets destroyed. Even in Weimar Republic and in Germany, everything was collapsing, but the price of gold remained. It went up, but you could actually trade with gold. So gold is always a safe haven. And also, as you can see in different parts of Asia, for example, China's real estate, which is basically collapsing, now people have to go and fund managers need to create new returns, and gold seems to be the place because they're following the central bank's buys of gold. So I think Chinese investors are looking for assets whose value is also independent from government policies, but also as a good alternative to generate returns. If you see the correlations for gold in the last 10 years, is remarkably well. The highest correlation is to the 3-year treasury bond, or to the 7 and 10 years. So basically everything under 10 years to the treasury is only 0.25, the standard deviation. Basically, doesn't matter. The S&P 500 is almost 0.04, so basically a zero correlation, which gives a lot of excellent diversification purposes. The highest, of course, is commodities, because commodities have that component of mining, but in the actual asset, like in the actual, your real assets, not real assets, but your common assets, not your alternative assets, gold provides extremely good correlation and diversification. And this is the graph that we want to see. In the last 20 years, the price of gold completely inverse to the price of, or to the US index. Of course, this is in a scale graph, right, for USD. You can see the price to the right. Currently, we saw that the US dollar 2 weeks ago was at 101. Now it dropped a little to 100. The 200-day moving average is at 103.65, so trending down. But gold has kept going and going. And every time you see gold rises, gold goes down. The US dollar drops, gold goes up. And you could see that it's in the beginning of the last decade, in 2010 to 2015, when interest rates were basically at zero. So gold increased as the USD weakened. And this is the prices for adjusted. So we are reaching all-time high, close to what it was in the 78 to 79 period. CPI adjusted, but non-CPI adjusted, we are at all-time high with 25.78 per ounce for gold. And this is a really interesting graph, which we think is why gold is doing so well. It's because, as we see, this is an efficient frontier, basically, of every asset class in the last 17 years. You can see the gold ETF, because we understand if physical gold can also alter price, right? If you buy gold and you are going to sell it, usually your buyer is going to take a small cut. With an ETF, that doesn't happen. You get spot price right on. So basically, you can see gold is around 6.5% annualized return, with around 17% in standard deviation, which gives a better risk-reward ratio than investment-grade corporate bonds, that every treasury bond, ETF, that commodities, that emerging markets. Basically gives better than even real estate, because similar returns but less risk. So gold is only defeated in a better risk-to-reward ratio to stocks, to the S&P 500 and mid-cap and small-cap. So let us know what you think. I think gold will continue to rise in the course of 2024. 2025 we'll see as interest rates get cut, but with deficits and the fiat currency just getting weaker and weaker, we might see gold shining for more years. So let us know what you think, and don't forget to subscribe. Thank you.